Hello, everyone, and thank you for joining us today for our webinar covering trends in deal making. I'm Danielle Fugazi, and I'll be your moderator today. I would also like to thank M&A for hosting this and our sponsor, Affinity. I think, as everybody on this call knows, uh, deal makers are as busy as ever sourcing deals, and it's not easy in today's environment. There's a litany of different issues I could talk about, but I'm gonna go ahead and let everybody on this call tell me what they're thinking about. But we are gonna talk about some of those challenges that we face, that the industry faces, and how deal makers are looking to transact and solve some of those issues. I want to remind the audience that you are in a listen only mode, so please chat your questions into the chat panel. I will get those and I will be sure to pose them to our esteemed panelists here today. Um, so with that, I'm happy to just jump right into conversation. I'm going to let our panelists introduce themselves, and then we'll go ahead and just get into our talking points. So I want to thank you all for being here. And Gretchen, why don't we start with you? Can you introduce yourself, please?
Absolutely. Thanks, Danielle. Good to see you, see you, and hello to everybody on the webinar. Thank you, M&A. Thank you, Affinity. I'm Gretchen Perkins. I'm a partner with Avance Investment Management. We're a new private equity fund, offices in New York City and Miami. We are focusing on lower middle market businesses in broadly services, technology, and consumer. Enterprise value for us target is 50 to 250 million. And we very much like to help founder-owned businesses grow and accomplish more with our partnership than they could on themselves when they're by themselves when they're ready for a sponsor type of experienced investor.
Great, thanks, Gretchen. Jeff, you want to introduce yourself and your firm?
Sure. Yeah, thanks, Danielle. Thanks, everybody. So, Jeffrey Stevenson, I'm managing partner of VSS. We're also focused on the lower middle market, particularly in healthcare, education, and tech-enabled business services. Mainly what we're doing is investing a combination of debt and equity to be a capital provider to facilitate growth. Oftentimes, it's a founder entrepreneur that's looking for capital to provide a liquidity solution and or capital for growth, often through add-on acquisitions. We've invested in about 100 different companies over the years that have done 400 add-on acquisitions. So that's really the playbook that we have, and we're investing now out of our 8th fund.
We hope to be you one day, Jeff.
Let's partner, Gretchen.
This is good. And Jeremy, last but certainly not least, can you introduce yourself and your firm?
Absolutely. Hey, everyone. Good to be here. And thank you, Gretchen and Jeffrey, for joining today. I'm Director of Product Marketing at Affinity. Affinity is a relationship intelligence platform and CRM specifically built for industries like private equity, investment banking, venture capital. And our goal is to help have a tool that can help you automate manual CRM work, enrich your CRM records with third-party data that's useful to your workflows, managing your pipeline more transparently, and most importantly, truly understanding your entire firm's network of relationships and how they relate to each other to hopefully help you source prospect more efficiently through warm introduction opportunities that you might not have known were there or previously siloed in various teams. Good to be here today and excited to learn about how to prepare for second half of the year and what's ahead.
Yeah, perfect. Thanks, Jeremy. Okay, so let's start by talking a little bit high level here. Can you guys just tell me a little bit about the challenges that you're facing or that you see going into the second half of the year, even into 2023? Listen, I want this to be conversational, but just given that it's webinar, Gretchen, why don't we start with you if that's okay, and then we can go ahead and anybody can add on there.
Sure. Well, I think the big issue for most investors right now, no matter what sector you're in, is inflation. and what does that do to your revenue stream, your underwriting? What does it do to the supply chain and the margin impacts? The new inflation numbers came out for August, and they had dropped, I think, a point one. So instead of, I think we're down to 8.1 for the year, which is still super high, right? I mean, I'm sure there's a whole bunch of people on this webinar watching that are 35 or under and have never experienced a high inflation environment. And Jeff and I can tell you, Jeremy, I don't know how old you are. Danielle, Jeff and I can tell you that it changes everything. It really impacts every variable that you're agonizing over in your models. So some industries will benefit, some will be hurt, but the overall effect is, exactly what the Fed's, trying to do with interest rates is to generally dampen things. So that's what we're trying to underwrite kind of broadly. We can dive into more details, but I'll let Jeff take it from here.
Yeah, I would agree with everything that Gretchen just said. I think that inflation is a big issue. I think particularly in the area of wage inflation, I think everything having to do with retaining and attracting talent is critically important right now, and it's especially important as you evaluate where the run rate EBITDA is and where it's going to be going forward, because wages as they increase are higher in the past quarter than they were 4 quarters ago. So where is that heading, and where's the turnover, and what are the implications for next year? So there's a lot that's dynamic. I think that this all of the uncertainty that's going on in the marketplace is of course a challenge, but it's also an opportunity. So I think that we're in there at a granular level in terms of being hands-on with these portfolio companies. So I think we view the current environment as more of an opportunity for us than not. I mean, there's still a huge gap in terms of valuation, a growing gap at this moment. I mean, the public markets, I think just checked a few moments ago, are down close to 1,000 points, 800 and change. So the private markets have not caught up yet. There's still a big gap there. I think we're seeing relatively high multiples. So, that I think is particularly challenging because, none of us knows whether or not we're going to be entering a recession or other, issues geopolitically, et cetera, et cetera. So, rationalizing those multiples, I think is, what we're all kind of contending with in terms of what's, how we peer around the corner.
So that's perfect. That kind of leads me into the next thing that I wanted to talk about here. Jeremy, I didn't mean to leave you if you have anything to add at this moment, but I did want to talk about navigating the valuations, the uncertainty in the valuations. Jeffrey, if you want to go ahead and start again, what would you say about the deal sourcing environment, and then again navigating the uncertainty in in valuations today?
The deal sourcing environment, I always felt that, this is the lifeblood of the private equity business. You need to have ample, robust, and high quality deal flow. So we invest a lot in that, in developing relationships, both directly and indirectly, in order to generate, a significant amount of deal flow so that we have opportunities to choose from. We probably see about 500 deals in the span of a year and maybe do 5 deals. We're reaching out directly. We're reaching out through a lot of boutique intermediaries. We're attending a lot of conferences. We're using a lot of data sources. So deal sourcing, and we're investing in increasing the size of our business development group. And identifying areas, within our particular markets of healthcare, education, and business services that we find are most attractive. I think on the valuation aspect of it, and this, I think valuations have been high. I think they've been high as long as I've been in the private equity business.
They never go down.
Yeah, they so I think the way we've been dealing with that of late is by going smaller and starting off with smaller platforms. For example, we're in healthcare services and focusing on the dental space, rolling up clinics. We started off in the endodontic market, so it's root canals. And that company had originally 6 practices we started off with. We now have, I think, about 180 practices.
Wow.
So even though we started very, very small, we backed a team that we thought had the ambition and the capability to scale, which we've done, probably exceeding our original expectations by quite a bit. But smaller EBITDA businesses have their own risks. But I think if you get it right in terms of management and you have to invest in building out the corporate office, then that's one way of starting off with a lower multiple to get in.
That's a good point. There are lots of opportunity in valuation, but they are on acquisitions. But it can be really rewarding when you get it right. You've got a management team. I'll take a different tact. We're very thematically focused. So and while all of so relationships with the banks and more specifically the bankers that traffic in these spaces is very important, so that you're on the short list, you're on the five firm fireside chat list before the teaser comes out. You are you get first dibs and maybe better guidance on what it's going to take to accomplish a transaction because of your relationship with the bankers. Lots of bankers in our space, kind of the lower middle market space Jeff and I traffic in, have coverage bankers, which is awesome, right? That just makes the sourcing job so much easier. They're the traffic cop that I or Jeff or our colleagues can go to that one person at a very large organization, and they can line us up with their healthcare, women's healthcare people who cover that, or the technology managed services people, whatever that is. And that's great. But many bankers and advisors in the lower middle market do not have that functionality. And so you actually have to know which bankers, you got to be on a first name basis with the bankers at hundreds of firms that play in our areas. That's when it's critical. It's critical because I can't remember. I must have a CRM, a technology solution into which all of that can be stored and sliced and diced and incorporated into your programmatic outreach plan, whether it's those healthcare bankers you're going to call every quarter, or those you're only going to call twice a year, or those you really only need to call once a year or send blast emails to. So all of that being centralized, and number two, very obviously the information has to be in there. So you have to develop an organizational habit of entering that stuff, right? We all leverage various colleagues of ours outside of the sourcing primary function to help cultivate those relationships. And if organizationally people are not entering that data into the database, the central database for the whole firm to access and use, then you're leaving a lot of power and connectivity on the table.
So there's so many things I want to talk about there, but Jeremy, you probably have something there that you've given Affinity. You want to comment on Gretchen's thoughts?
Absolutely. Yeah, to kind of tag on to that. Yeah, we definitely believe here at Affinity, having those well fostered relationships can really lead to better increase in deal flow, maybe even having your deals more seriously considered. And later on, hopefully, there's room for maybe faster consensus to where valuations land. And I would actually be curious to hear from you both, like, is the relationships you have with these banks, has that impacted positively or not the kind of coming to a consensus on valuations in a more timely manner? Because we've also seen users in our product, they've had a 21% increase in kind of the time to close when they're engaging with folks that they've already known in the past or have worked with in the past quite frequently.
Yeah, I would certainly agree that the relationship part of that is critically important. And what I've noticed over the years is that the intermediary market, all of these boutiques, especially at the lower end of the middle market where we operate, have really multiplied. I mean, literally hundreds and hundreds. And so there's really no other way of keeping track of that other than having a CRM that is got really good functionality and that you use, as Gretchen was describing beforehand. So, we have, I think, the latest number is something like 800 boutiques that we're tracking and we're seeing deals from. So that's, that more than anyone can do in their head or, put on their speed dial. So everything that, that's involved and having, and obviously you got to tier it and you've got to organize all of that data. And I think all of the stuff I think Gretchen outlined, but I don't know how you do it otherwise. So you really want to have relationships with these investment banks where they, know you well enough so you get the call in the first instance. And ideally, because what's happening behind the scenes when they're talking up one group or another is that, we're bringing certain advantages we hope to the table, and that needs to be communicated. And of course, we're going to communicate it, but it's even better if the banker on the other side is communicating, how we add value and how we differentiate ourselves.
Yeah, I just add a little color commentary there. Getting that early phone call gives you the chance to do some work on the space, right? We have a head of research here, gentleman who is a partner at BCG and has done, hundreds and hundreds of private equity market studies and market maps. And whether you have that specialized function in your firm or your associates are doing some research or you're using another outside firm, whatever it is, you have some time to get smart about the sector. And even if it was on a no names basis and a banker said, hey, in 6 months we're coming to market with this residential services business and roofing or something, for example, you can start getting really smart. You can create an informational deck, get that in the banker's hands, and then, as Jeff was saying, the banker is advocating for you. Like, look at all this work they've done. Look at how much they already know about your sector. Look how, this is clearly an area of active interest for them. Even if you're a new fund like us and we don't have a long history of deals yet, we've only done 4 at our current firm. Obviously, we can talk about our past firms, but it just is very helpful. And Jeremy, I find that interesting. You have a number, X percent, faster to close. I can't confirm that because I've never measured it, but anecdotally, yes, definitely, you can close faster where you have a strong relationship. And because ultimately the advisor to the client wants 2 things. They want to earn their fee, and they want it to be the strongest possible number, but more importantly, they want the deal to close. And if you have a great relationship, you've maintained contact, you've shown you're reliable through lots of relationship building over the years, they are your best advocate because obviously they've been hired by the seller, and the seller can say, I know these guys, look at all this work they've done, they'll get this closed in 4 weeks or something like that.
So that brings me to my next question, which is about the relationships and how you build those deep relationships. I think there was probably a time where bankers and private equity firms could just call on one another because it was so small. But there's a proliferation of private equity firms, a proliferation of investment banks. It's really hard to touch everybody that you probably want to or need to. I'm wondering if you guys can comment a little bit about how you do maintain those relationships. Do you use technology? Is it through content? There's a lot more. I don't know. I guess I'm going to stop talking and pose that question actually to you.
Well, we use blast emails, right, from our CRM. The only social media we feel comfortable posting on as a regulated SEC firm is LinkedIn. So I don't know if you can call that social media, but it is social media for nerds who are regulated. Um, um, but that's how, in addition to active, firm-wide assignments on bankers they're supposed to cover at certain tiers and certain cadences, we send out blast emails and post things on our LinkedIn.
Yeah, and I think we probably do a lot of the same things. We track all of this via the CRM that we use, and that's tracking deals as well as the interactions we have with the intermediaries. But of course, it goes beyond that because you're also attending conferences, you're mapping markets, you're identifying prospects. You're calling on companies on a direct basis, be it thematic or however one approaches it. And so we have a whole variety of data sources that we're using to filter that information and to use that information to approach the market. The banks are one channel, if you will, but you really want to organize it all through the CRM. Getting that adopted across the board within the firm, I've always found is the biggest challenge. Some people are nimble, active users, some not so much. But ideally, get as much information in there as possible. I think that one of the things I'm always amused by is this word called proprietary. I find that that's a very small p these days. And turns out proprietary deal flow includes having an intermediary. Who would have thought that? But maybe it's a limited process in that definition of proprietary. But we're calling on companies directly, and I think the best way of doing that is to do it in a narrow, focused way, and using some of these data sources to identify some of those targets and mapping the market, and whether you meet them at conferences or by Zoom more and more often. Which has actually been a great development. Just the fact we're doing this conference right now, there's so much more potential for outreach versus the legwork of getting on a plane.
Very true. You can apply any of the comments we've made regarding covering bankers to covering direct company calling as well. There's, as I said, we're thematically based, and there's definitely companies we're tracking on a proactive basis. Some of them are, they came out in a market map, so a good chunk of them are private equity owned, right? Because a good chunk of the United States private middle market companies, lower middle market companies, are owned by private equity now. It's been a reliable source of capital for 25 years. And so some of those businesses will be owned by other private equity firms. And so there's outreach, hey, we're interested in this space, see all this work we've done. When you're ready to sell, we want to make sure we make the list. Obviously, we know if it's private equity owned, they're gonna use banker. But that's okay. You're still showing early interest to the party that wants to transact, wants to get their return. So it's still helpful. And then obviously the truly proprietary businesses that are founder-owned, not represented yet. And you want to track them. You want to track them for sure. These business owners get 40 calls a week. They say these days, like, you wouldn't believe how many calls they get, inbound calls. But I think going to trade shows and seeing these folks in person in a trade show environment is something we do. Someone on the team who's assigned to all of our thematic areas attends trade shows, specifically with the hope of, bumping into owners or, presidents, CFOs of target sector companies. And that's a years long, that doesn't, you don't go to a trade show usually. I literally have done this once in my career, met a business at a trade show, did that deal, 7 months later. That's very unusual. Usually you go and go and go and develop relationships and develop sector knowledge of the people and of the companies. And that all has to be tracked, right? You can't just, you'll never go year after year after year and remember who you talked to, who was there. You want to show up having the notes fresh from your last encounter when you go to the trade show again. That's just one strategy. Conferences, any of those types of things, they're all important.
And just to touch on a couple of things that you both actually shared regarding technology and techniques, we've found, the automation. So there's some solutions, Affinity being one, where this idea of automation can really help firms achieve this goal of having complete and trusted data in their CRM, for example, where you're able to, kind of not have to worry about manually logging your meetings or your engagements or your notes. These things can be kind of done on the side automatically, so you can focus on the more important stuff, like making sure relationships aren't falling through the cracks and you're nurturing them appropriately over these long cycles, like Gretchen, you're saying. And then Jeffrey, about the adoption, having some of this kind of harder, maybe more painful duties around manual data entry, that can also help adoption and kind of make the tool much easier to use. And then you can do some cool stuff as well by calculating your relationship strengths by having this complete data where you can kind of see who's engaging with who the most, what cadence and the frequency, and then also saving some time, in addition to your proprietary data, as you said, kind of mapping the market with third-party market intelligence, being able to kind of automatically pull that into one screen, so you can kind of have a better, more holistic picture of kind of who you should be going after, who you should be keeping tabs on from an opportunity perspective.
You know what, Jeremy? That just triggered in me another kind of output and reason how I use a technology solution in sourcing. I'll divide up the country in, the broad regional segments: Northeast, Southeast, West, Midwest, Pacific Northwest. And, most of the companies and the intermediaries or wealth advisors or lenders or whoever traffics, they're all clustered in the major population centers for obvious reasons. So I'll take a look at that a couple times a year and say, we've seen nothing from the Southwest this year. It's June, we've seen nothing from the Southwest. That's really odd. And so might cause me to say I should make a trip out to, Phoenix or Denver or Houston or something like that. But then I'll check it again later in the year, and I have a choice with that information, not seeing very many deals in the Southwest. That either means, one, you're not calling enough there, and so you need to go more and you will find deals, because, going out and meeting people and asking for the business actually really works. Number two, you could also look at that and say, there's just not that many actionable deals for us in the Southwest based upon our sectors. So you really have to, so it's okay that I'm not seeing as many from there because most of these deals are clustered, most of these businesses are clustered elsewhere in the United States. So it's not an obvious answer one way or another. You really need to dig into it, and you can only get that sort of market overview through a technology solution.
So I have a lot of different questions also based on the list comments. But Jeremy, I just want to quickly get back to something you said, which was taking like the manual process out of using the CRM. Can you just touch on what you mean by that? I mean, like there's no data entry, it sounded like you were saying.
Yeah, happy to share a little bit more. So kind of at a high level, Affinity would sit on top of your email and calendar to begin with, and they're able to, automatically pull the meetings you're having, emails that you're exchanging into your CRM, creating contacts, new companies, logging all of your engagement history, and it doesn't just stop at email and meetings as well. You have abilities to pull in your chats, your phone calls. So it's really a way to build that single source of truth when it comes to how you're engaging with your various people in your network. But then also making sure that that's transparent across your firm. If that's something that you want, you can, of course, provision data however best fits your company. But sometimes, it can be a pain to kind of get up to speed on a prospect or an opportunity if you don't have a good access to the information, whether your team members have been engaging with them or others outside of yourself. You can make sure that, again, one, you're able to see all of the engagements, and two, if you weren't involved previously, you're able to get up to speed really quickly in preparation for a call, for example.
So thank you, Jeremy. Do you guys find now with all this technology and tracking of deals and so much being private equity backed that you can almost time when a company that you may have interested is going to come to market again? I mean, do you watch it that closely? It feels like it it could be that, I don't want to say simple, but that you kind of can time this a little more than you used to be able to with the use of technology and just how sophisticated and mature the industry has come. Is that, I don't know, Jeff, any feeling, Gretchen?
Well, I think you certainly could do that with all the information that's out there. I guess the question is, do you really want to do that? I mean, we'd rather not necessarily buy from another private equity fund. I mean, the nature of what we're trying to do is invest, again, with the founder entrepreneur at that initial capital formation stage where they're bringing in, not from a venture startup point of view, but from the standpoint of, they're at that inflection point. They want to now raise capital to make add-on acquisitions. They've got a established profitable business. Certainly there is a increasing and meaningful percentage of deals that are now these, secondary, meaning, private equity to private equity type transactions. I think we're trying to start off a little further, or a little earlier in the food chain, and then ultimately kind of arbitrage that difference. But I would expect that, because there's so much visibility into the portfolios of all of these, from multiple data sets, you can figure out pretty easily how long they've held companies and, roughly speaking, when they're going to, but when they do go to market, they're going to go to market with a bank. And then that kind of comes back to, you need to be in front of the banks because, doing the one-off deal that's not being shopped that's few and far between.
Yeah, I'm not that good, Danielle. I'm not that good to have those. But when I am tracking businesses in a private equity portfolio, I'll look at when they when they acquired it, when they invested. And if it's been a year or two, they're probably not ready to sell. Although, Jeff would probably agree, hold times are coming down. And if it's been in their portfolio for 7 years or 8, it's a work in process. It's had some issues, because otherwise they'd sell it. Otherwise, we all would sell businesses at 4 or 5 years, given our druthers, maybe even less. And if you've held it for that many years, there's been some struggles, which is okay. But again, that's a level of detail that I don't currently have into my systems. But you're on the right track.
Would you say having these relationships, building these relationships with the intermediaries helps you close more deals, or close the right deals, or just see more opportunities?
Well, it's all of that, but it's also intermediaries are great sources of industry information and trends, especially those that are living all their deals in a certain sector. A coverage banker for women's healthcare, for example. They have tons of information about issues. Maybe there's some issue with one of the insurance company payers that is, very well known in, I don't want to besmirch any, but maybe there's some payer that's not behaving like they did in the past, and so that will impact any businesses that are, that their procedures or their service is getting paid for by one of the health coverage companies. And those investment bankers can tell you, yeah, look out for that, check this business. So we always call numerous bankers before we issue an IOI and say, any trends going on that those of us who are not spending 24/7 in this space should know are happening before we put a valuation peg, in the seller's mind. So yeah, the relationships they're super helpful for, on a deal by deal basis, but they're just also really valuable for an outlook on, the topic of the conversation, right? Outlook for 2022 and beyond. They can. I'm going to stick with the healthcare industry because this is where bankers just have been very helpful to us. They can say, oh, there's going to be a reimbursement change that's being talked about, in Congress right now. That I'm not following all the healthcare bills in Congress, but the investment bankers or the lenders have seen that and heard that through their, being very, very active in that space. So they help us spot trends that are coming. They help us, especially, when supply chains started really constricting. I'm not saying way back in the pandemic. I'm saying first half of this year, when the Ukraine war began, and then there was all these sanctions between, the U.S. and Russia and Europe and Russia and all the geopolitics of this. Like, I didn't know Russia supplied a ton of things that electric car batteries need, right? I didn't know they supplied a bunch of wool, or I hadn't thought of that they supply a bunch of wood pulp, which goes in everything, right? And because of U.S. sanctions, we can't get the same supply of wood pulp. So what do you do with that? You say, okay, prices are going to go up on the supply, on the cost of material side of any business we're looking at where their input is wood pulp. So it's much more, they're a wealth of information. We love our bankers.
Okay. So just flipping things a little bit, I know you love your bankers, but is there anything that you think on their side that they could be doing more effectively to work better with you guys?
I'll let Jeff take that one. Jeff's up.
Well, I think that I'd say the more transparency into areas of risk the better. I mean, I think that, I think what we find sometimes in a process is that some of the problems are not necessarily made evident, and the odds are that we're going to find it in due diligence. And I think that the banker is much, much better off dealing with that, whatever that issue is, up front, because then, as a result of knowing that, then you can price the deal accordingly. And I think that the certainty to close ends up being much higher. Sometimes, we find that, if you're, you know, if that's not quite as obvious or made obvious, and you have to dig for it, then you can have a failed process. Now, actually, from our standpoint, we sort of like a failed process because we can kind of go in and the price is a little bit lower, but it can also make for a very frustrating process and a very inefficient process, because no one wants to, because going through a process is not just expensive in terms of the time that's invested, but all of the money that gets spent on third-party sources, be it Q of E and market studies and so on and so on and so forth, does not make for an efficient process if you don't know what some of those issues are up front. So I think that would be, to me, the most important thing is that, if there's a problem, just kind of get it out there, so that you're dealing with it in a way that you're communicating and you're getting people comfortable, the buyers, comfortable or not. And if not, then, move on to the next one. And then as a result, you're going to have a closing that, going through the process is just, better informed for all parties.
Yeah, candor definitely wins the day and wins the decade and the multiple decades for a relationship, right? I mean, we don't really want to be transactional, even though transactions are what we do. We want to, invest in businesses along a continuum of a long relationship period between the two parties on either side. And candor really helps. That really helps in that. Helps build trust. And agree, it's just inefficient to hide things. That's silly. We're always gonna find them out, right? And then we're a month down the road, and nobody is any better off for that. And it starts to make, on the buy side, we start to think, well, what else have they not told us? Maybe our multiple's a little too aggressive. Maybe they really can't support these growth projections. So I've never understood that, by not revealing that kind of stuff. Sometimes even at the teaser stage, like if there's a giant customer concentration, and giant is anything over 40%, why don't you just put that in the teaser? Save us all some time. For us, that's a deal killer. We're not going to execute that NDA. It's annoying to have to go through the rigmarole of that. And maybe your clients are demanding that, and I understand that. But one thing that I think the intermediary market has been doing in the last 2 years very well, and I want to applaud it and say thank you very much, is that the follow-up on deals, if I haven't responded to a deal that someone sent me last week, because things get buried. This market is hot. I can't believe how many deals are coming in. Like Jeff, we want to bring in like 500 tops, but you get a lot more than that, right? You gotta parse through and triage them and bring in the ones you want, and politely and respectfully decline the ones you don't want. And everybody misses things. And it used to be, a lot of times the banker would never follow up, and maybe that's because their process was so strong. I don't know. Processes are very strong right now, but I have found that there's a lot more diligence in someone on the deal team reaching out and saying, hey, just bumping this up. I'm assuming it got buried. We thought this was a really good one for you. I appreciate that immensely, and I'm not, no apologies to say I need it.
I think another thing that's actually gotten better, and it's I think it helps the process. Might be more work, but as a result of technology and being able to do this sort of thing online, having these interactions with management up front before you get on a plane is makes everything much more efficient. I think for both sides, because it used to be that you hop on a plane, you go to a management presentation, and then you decide whether or not you're interested. Well, you should be able to determine that from your desk, in front of a camera. And then you're going to spend 3-4 hours in a management presentation, and it's much better time spent for both sides, and you probably have a dinner beforehand. And so all of that, plus the travel time, adds up to a lot of time. So I think actually processes in that regard have improved a lot. And I think so at the front end. And then also we found, throughout the process, we end up having a lot more interaction with management, and you get on a phone and you talk about a particular issue or, something in the data room or whatever it happens to be. And there's a lot, I think there's the information flow, it ends up being better as a result of how we're doing it these days.
Okay, I have plenty of more questions I can pose here, but I do want to get to some of the audience questions. I want to just also briefly remind the audience that they can go ahead and chat their questions into the comment section, and I will share them with our panelists. So the first question I want to ask you is about referral intermediaries. How often do you work with referral intermediaries? And what is the success rates? Any feelings or comments about refer intermediaries as a source?
Can you define that for us? How are you, can you explain what to you a referral intermediary is?
Is that on the buy side, you mean?
I think so. I mean, I've gotten this as a question. I think that's.
Or maybe it's brokered, Jeff. Maybe they're talking about, like there is an intermediary assigned and another intermediary looking for a buy side fee has introduced us to the auction that we somehow didn't know about. I think that's what they're talking about.
Don't know. I think if it's on, I'm thinking it might be on the buy side, referring you to a deal, and we would welcome that. I mean, we would pay fees on the buy side. Deal flow is incredibly valuable. So for all the reasons we were talking beforehand about the many things that we do in terms of attending conferences and calling on intermediaries, if we have someone who has an idea and is going to refer an opportunity, we would welcome it, number one, and we pay for it, number two.
Agree. If it's an intermediary who's not engaged by the seller, and they want to introduce us to a founder, an owner of a business, and there's no intermediary involved, absolutely pay full fee, full Lehman-based fee. If it's one of those referral brokers, referral intermediaries introducing me to a process, also still valuable, because for some reason I didn't get that email. We're a new firm. Not everybody has moved us over from our old firms in their CRMs to our new firms. There's been a lot of movement during the time from the pandemic in every group. It's really hard to keep up. So definitely it's worth something. It's worth a little bit less to me because you're introducing me to a process. But it all depends on how badly we want to see the deal. So, I may try to negotiate a less than 100% referral fee, buy side fee, if it's, you kind of introduce me to a robust auction. But again, it really all depends on how badly we want to see the deal. But I echo Jeff's point. Deal flow is very valuable. We're happy to pay for it.
In your opinion, what are the selling points that will make a deal stand out for you?
Mhm. Where do you start on that one?
Right.
It's a long list. I'm not sure this is necessarily in order, but management. We've had opportunities where maybe the marketing materials were not the best, but we got in front of management and we were wowed by the team and totally convinced that they can deliver the upside. Especially with our kinds of businesses, probably, I'm sure, for the industries Gretchen's covering as well, it's, management that can make the difference between a successful deal and an unsuccessful one. So I'd start with management. Then of course, I'd go to the market opportunity. It's nice to have some tailwinds in that regard. So we like fragmented markets where there's an opportunity to consolidate, where there's intrinsic growth in that market, and then there's a robust set of buyers at the other end. Then third, the business itself, and what level of performance has it had? What are its prospects for growth? Is it a platform? Can you make add-on acquisitions? Is there a near-term upside? I think those are kind of some of the things that come to mind.
Jeff answered that very well. Ditto. The only thing I would add for us, for my firm in particular, is if there is some element in the ownership or the customer base or the employee base that has a diverse aspect to it. Gender, ethnicity, you name it. Our firm is very intentionally, we've built it to be a diverse representation of the United States. I'd encourage you to look at the team page on our website. We have 2/3 of our firm are women or people of color. And again, very, very intentional and has been very powerful for deal sourcing in various ethnicities, in winning a deal. And we're trying to harness that power. So if a business has all those great aspects that Jeff outlined, and has some diverse aspect to it, that really stands out for us, and we'll take an even harder look at that.
Okay, so with that, I do have a lot more questions here, but I do want to get everybody's opinion before we go. Just some parting thoughts, any bright spots you guys are thinking about. I want to just kind of bring it all back to, second half year, 2023. What are you guys thinking about? I give everybody an opportunity to answer. I don't know who wants to go first here.
Let's let Jeremy go first. We've been hogging the mic.
Any
No,
thoughts, Jeremy?
It's been wonderful listening. Yeah, I would say, looking into second half of the year and moving forward, we're focused on how we can help firms remain more competitive, whether that's through getting to deals faster, through better insights, cutting through the competitive noise by better harnessing the relationships and having that familiar face to talk to and kind of stand out around the crowd as deal flow is continuing to be healthy. And I would also say, just again, further enabling folks to nurture the relationships, whether that's or cultivate them as well, whether that's more targeted outreach. So you're coming to the discussion with very relevant information that the other party would be genuinely interested in. That you can have this confident, customized conversation, and it's not a spray and pray kind of wide net casting approach. But then also, effectively nurturing those relationships. So again, you're top of mind, and you're the one that is ready to take action, and you're the first on the top of their minds when they're ready to sell or buy, et cetera.
So I guess what excites us about the current environment really is many respects similar to the past. and that is working with these entrepreneurial companies. And one of the things I'm excited about, in addition to that, right now is our team. We have a really great team and extremely seasoned and very knowledgeable about these markets, and how we apply that to these companies we invest in. Where, as I mentioned beforehand, we're investing at what we're looking for in terms of an inflection point where an entrepreneur has built a business and now is looking for a capital provider. And how can we take that or help take that company and work with the management team to the next level? That's particularly exciting. And the other thing that strikes me is probably more recent vintage is the impact of COVID on how businesses operate. I've been amazed at how some of these companies have adapted to this environment, meaning that whereas it might have been a physical in-person sales process beforehand, and now overnight, companies are now marketing themselves via Zoom and other online sources. I mean, it happened quickly, and it's also expanded the potential of those prospects for customers for those companies. From being very limiting in terms of the getting on planes and meeting customers in person to doing the kind of thing we're doing on this call. It really expands the reach of a company, and we've seen just huge benefits from a financial standpoint in terms of how these companies have been able to respond to that, those changes in the marketplace. And technology has enabled all of that.
Yeah, I'm generally a very optimistic person to begin with, so my answer will be optimistic. The U.S. economy has proven to be extremely resilient and bounces back from extreme shocks, as we've all just lived through one, but there's many more that have happened in the past, and it bounces back stronger, with stronger, bigger growth than ever. So if we do enter a downturn next year from any number of crazy things that could happen, it will cause a temporary decline in the number of deals that are in the market, right? Business owners don't want to sell their business at a time when their numbers are down. Enter a downturn, businesses, more businesses are showing negative growth from 2022 versus other businesses that are, growing. Things will go down for a little bit, but it will right itself and it will come back. And those early days, for those of us who've been through, 3 or 4 economic downturns in their career, those early days of the glimmers of, okay, we're done with the downturn. There are many businesses that need to sell in that, and they'll still be in market, and you can really pick up some great businesses that will grow when the bounce back happens. And so it's a really good time. And then you've got a runway of kind of blue skies and growth ahead of you for some number of years. Something I'm really excited about also in terms of helping these middle market businesses grow is applying digital marketing techniques, like really smart digital marketing resources, whether it's a consumer facing business product or service or not. Most middle market, lower middle market companies in particular have minimal to no digital marketing expertise in-house, and they probably haven't paid for it because they've been doing just fine without it. And there are huge opportunities for growth and gain and efficiencies in applying those, really optimizing digital marketing and outreach to our portcos customers. So excited about that. Seems like there's a lot of low-hanging fruit in that regard.
Thank you for that. We are out of time. So Gretchen, Jeffrey, Jeremy, I want to thank you all for coming on and sharing your insights with us today. I want to thank everybody for listening. And of course, I want to thank Affinity and M&A for hosting. Have a great rest of your day, everybody.
Thanks, everyone.
Thank you.